there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney says Canada will change its auto framework to help local production. He says Canada will also change its tariff system to incentivize automakers to invest in Canada. Ottawa is launching consultations on a new import credit scheme to help automakers lower their tariff bill based on Canadian production. The federal government will also drop the 2035 EV mandate and bring back the consumer EV incentive. And shares of Canada Goose are plunging today. That's after the luxury parka maker posted profit in its latest quarter that missed estimates. The disappointing results are due to heavier marketing spending and one-time charges. On the upside, direct-to-consumer revenue rose by 14%, led by strong performance in North America and Asia. And shares of Barrick Mining are sliding today, too. The miner posted profit and revenue in its latest quarter that topped estimates. But investors are pointing to the company's weak outlook for 2026 production, as well as free cash flow that came in below expectations. Barrick also says it will spin off its North American gold assets into an IPO, which will include interests in Nevada and the Dominican Republic. We'll take a quick look at the markets here. The TSX is down by 1.3%, hovering around that range today. We know gold and silver prices are down, driving those stocks down, which of course is driving the TSX down. If we look at U.S. markets and how they're performing today, all trading down at the moment. Of course, tech stocks, particularly in the U.S., are down today, and that's affecting the S&P 500 and the NASDAQ in particular. Shares of BCE are trading lower after the company missed revenue expectations. Joining us now to break down BCE's fourth quarter results, the performance of its new U.S. acquisition of Ziply Fiber, and how AI is shaping the business is Curtis Millen, CFO of BCE and Bell Canada. It's good to have you join us today, sir. Thanks for taking the time.
Hi, Lindsay. Thanks for having me.
Let's start with BCE reporting lower revenue than what most analysts were expecting. What was driving those numbers there?
Yeah, I think ultimately, Lindsay, you're seeing a few things happening. Service revenue, it's important to point out, service revenue actually grew. Product revenue, which was a decision we made strategically, product revenue is down as volumes in market were a little bit down. So wireless prices were a little bit down in industry, so fewer contracted sales, but basically decision-making on our part, strong growth, but more bring your own device and fewer contracted sales. So it leads to product revenue weakness, but ultimately service revenue strength. Even more importantly, if you look at 2025, free cash flow growth of 10%, free cash flow growth post lease repayments, 17.5% free cash growth year over year. And importantly, we're driving that free cash flow strength while we continue to invest in our business. So $3.7 billion of CapEx in full year. We continue to invest for the future, so we feel pretty strong about our ability to generate free cash flow going forward.
And we are, of course, going to get to some of the investments that Bell is making. But just first of all, just going back to the earnings report, like you posted better than expected profit this quarter. So tell us what's behind that side of it. Is that because of the investments you've made?
It's investments we've made, but I'd say it's also just investments we've made in our customers and our products. So we tend to think about, the first of our four strategic pillars is in kind of put the customer first. So, the focus on improving customer experience is really showing results, not only in our gross ads in terms of sales and market, but there's been a churn improvement 3 quarters in a row at this point. So, we still have the ability to go out and create new customers, new sales, but we're holding on to our customers more and more as we improve customer experience and reduce churn. So ultimately that leads to better financial results, but it all starts with better customer experience and lowering churn.
Is that why you're holding on to your customers, better customer experience, or is it more of a lack of competition?
No, I mean, look, this is a competitive industry. As we've all seen, pricing in the market is a competitive venture. So the offer and value that we're providing to customers continues to go up, and our focus on leveraging technology to provide service when and how customers want it access to self-serve, better digital capabilities, and frankly, just delivering a better service and better experience day over day, week over week, month over month is driving improved churn performance.
Okay, so let's talk about some of the investments that Bell has been making. I know AI is a real big focus for BCE moving forward. It already has been. There are some data centers that Bell AI Fabric Network has invested in and is planning to help build out. Tell me more about those data centers. Where are they exactly, and where are we in the process?
Yeah, thanks for the question. I do think it's an interesting moment in time. I mean, AI is here. It will help reshape our economy. And if we can help be part of that kind of Canadian sovereign backbone, then I think it's good news for our shareholders, but good for the Canadian economy writ large. Ultimately, yes, given where we sit, given our telecom and ability to build out fiber, data centers, as well as we wrap Ateco and Bell Cyber capabilities around it, I think we're in a pretty good position to actually help accelerate AI adoption in Canada and play an infrastructure role and, as I said, kind of backbone of AI and data center role there. So good for the economy, good for our enterprise customers, and good for us financially.
What about the acquisition of Ziply Fiber? I know that was completed just kind of midway through last year. Is that part of Bell's kind of plan to integrate more into the U.S.?
Yeah, it's a fair question. I think the main story is fiber, right? Fiber is just a superior product to cable. I mean, it's superior in Canada. We see that with share of net adds. Our fiber loads are very strong where we have fiber. And it's a similar experience in other jurisdictions and including in the US. And it so happens that in Canada, we've built out far more fiber than they have on a relative basis in the US. So there's much less penetration of fiber. So we saw an opportunity to actually extend our capabilities, and it's a very strong management team in the US. So our combined capabilities are going to allow us to drive fiber growth in the US and bring fiber to communities in the US that frankly only have copper or cable. So we are first fiber in the market, which is why we're able to drive such growth and frankly meet customer demand.
What's the timeline for that, do you think?
I think it's ongoing. So we closed, as you said, 5 months left in 2025, and the ramp up there is just continuous at this point. We have plans to reach 3 million homes by the end of 2028. We're about halfway there, with plans to get to 2028 over a longer term horizon. But the opportunity is pretty significant. I mean, fiber ultimately just wins in the marketplace.
Got it. I remember at your investment day back in October, you announced, BCE announced it was going to save $1.5 billion in costs by 2028 through, quote, company-wide transformation and continued focus on operational efficiencies. Where specifically, where will these cost-saving measures come from in the company?
Yeah, thanks, Lindsay. And look, we're halfway there, and it's 100 different files and it's 100 different data points. But if I had to explain it under a broad theme, one is, as I talked about, our customer experience and customer efficiency is just getting better and better. So that means fewer calls to the call center. Folks are moving online. Customers are more comfortable in a digital world. So a lot more self-install, self-serve, digital capabilities. And as we improve our customer experience and customer service, again, frankly, folks don't have to call us or interact with us as much because they don't have problems they need to be solved. So the continuation of digital transformation across our entire kind of internal workflows, as well as all of our interactions with customers, ultimately lead to more efficient customer experience, happier customers, customer transactions, and more efficiencies for us on the cost saving side.
So the cost saving comes from customer satisfaction?
Yeah, ultimately, I mean, it's one of those rare cases where providing better customer service actually leads to more cost-efficient service as well. Okay,
just lastly, we were talking about competition a little bit earlier, a different kind of competition. This deal between Netflix and Warner Brothers Discovery, if that goes through, obviously that's still pending. There's a bit of back and forth there. How much do you anticipate that might hurt Crave's distribution deal with HBO?
Yeah, it's a fair question, Lindsay. Ultimately, at this point, I would point to a couple of facts. One is, we have a lot of content on Crave. kind of around the world, folks have recognized some shows that we have produced ourselves in Canada, Canadian content. So Empathie in French language at the start of the year, and more recently, Heated Rivalry. So we do have a lot of different content, not just from Warner Brothers or HBO on Crave. And I'd say it's a great service. I mean, we uploaded another 10,000 hours of content, and we loaded an incremental million subscribers through 2025. So 1 million new subscribers to our content streaming platform. So we're incredibly proud of the content that we produce and the streaming service that we offer to our customers.
So the potential deal between Netflix and Warner Brothers is not really a concern for BCE?
I think we're just going to continue doing what we're doing, and that's providing the right service with great content on air.
Okay, we will leave it there. That's all the time we have. Curtis Millen, CFO of BCE and Bell Canada. I appreciate you joining us today. Thanks so much.
Great. Thanks very much, Lindsay. Thanks for having me.
Thanks. Up next, we will explore how Canadian tech companies can keep top talent here at home. We've got more on that right after the break. Welcome back. The narrative in Canadian tech has often been dominated by the brain drain, the idea that to build world-class technology, you have to move south to the U.S. My next guest is hoping to prove that wrong. So joining me now is Suman Pushparaja, CEO of Predictive AI. It's good to have you join us. Thanks for taking the time.
Thank you, Lindsay, for having me on the show today.
Just to clarify, first of all, for our viewers, what is Predictive AI?
Predictive AI is a Canadian technology company that focuses on small language models. We built two different products. One is our fleet management product, which is called Shift. We mainly focus on transportation, aviation, and municipalities. Second product is called Cloud Rep, which is AI voice agents, which mainly focus on chat, email, voice, and SMS. These are mainly focused on small and enterprise businesses. We're not a concept. We are in production. We currently deployed our solutions with the United Nations, and we're having a successful pilot with Calgary Airport and WestJet as well.
Okay, so now let's get to the meat of the conversation, which is something you're hoping to prove wrong, is so many Canadian businesses, particularly tech startups, move to the U.S. Why is that?
Yes, I think, since AI has evolved, the way we can adopt technology and implement solutions are much easier now. And we have a lot of talent here in Canada. And we built our company here in Canada using Canadian talent. And we're currently in market and deploying globally as well. That kind of shows you that we're able to do that here.
But what's the reason for so many companies feeling like they can't do that here, right? Is it too much red tape around Canadian regulations?
No, I think the way tech, it has become a lot easier. Before, when you want to deploy certain solutions, you need to have certain skill set. Now, with technology, we're able to do that here locally, and things are shifting. And especially with what's happening around the world, a lot of companies and government are looking for Canadian-based tech. So, and that's also giving us an opportunity as well.
Oh, so you do feel like it's shifting, and more Canadian tech companies are staying in Canada rather than moving down south?
Exactly. And we are getting, like, say, for example, we are asked, especially because of the data concerns with the AI, people wanted to build technology here and keep the data here. That's a concern with a lot of the companies, because when you're training AI models, it's a risk. Suddenly you're risking not only your company, but also a lot of sensitive information.
Yeah, you're risking all that privacy when it comes to data. I wonder if you can explain more about how companies are able to keep that data here in Canada.
Yeah, so, of course, having your infrastructure is key. Being able to train locally the data and deploying it here, it's important as well. And those are some of the things that we're doing for our clients.
So is there anything else that you hope that maybe the Canadian government does to, like, I take your point, you feel that companies are feeling like they can stay and start up in Canada, but is there anything else that the Canadian government could be doing to help more companies feel like they don't need to move south?
Yeah, in terms of, I think the Canadian government is doing a good job in terms of policies and being able to support startups as well. And we're seeing that more and more, and everybody's talking about it, which kind of helps. And I think the messaging is, especially with what's happening with trade and et cetera, the countries are also looking for it as well. That's the message that we're getting from the government itself.
What's the biggest opportunity, I guess, do you see for companies in 2026 if they stay in Canada?
I think, as I mentioned, we looked at digital transformation in the past, and now there is an AI transformation. A lot of companies are looking for AI solutions, and there's a lot of opportunities here to build AI solutions and deploy, and we are seeing that with predictive AI.
Okay, Suman Pushparaja, CEO of Predictive AI. Really appreciate your time today. Thanks for coming on.
Thank you, Lindsay, for having me.
Coming up, hot picks. We are focusing on 3 picks in the biotech sector. That's coming up after this. Stay with us. Welcome back. It's time now for Hot Picks. Earlier, we zeroed in on the biotech sector with Laura Chico, Managing Director in Equity Research at Wedbush. And we kick things off with her top pick is Viridian Therapeutics.
All of our top picks here have 3 themes that really tie them together: rare disease focus, differentiated product, and potential catalysts. And that's exactly where Viridian fits. So their focus is thyroid eye disease, or TED. This is a rare disease, autoimmune condition, bulging, painful eyes. Your treatment options today are surgery or 6 months of IV infusions with an approved drug, Tepezza. And Viridian is really hoping to change this treatment dynamic. They have a drug under review right now, veligrotug. We're hoping to get an approval decision by June. And this would reduce both the number of infusions you need and the duration of each of those infusions. But I think the real interesting part for Viridian here is what's next. And that is this quarter, we're getting data from a trial called Reveal-1 for their next-gen product, Elegrobart. And this would be a once-a-month at-home injection, kind of like an Ozempic pen. So if we see Tepezza-like efficacy in this first quarter data, I think that's a real game changer in terms of how we treat TED, but also a re-rating would be due for the stock here.
You said this is a rare disease, though, so the market is curtailed in that sense?
Yeah, so we're talking about fewer than 200,000 patients in the U.S.
Right. So what should investors bear in mind then? I mean, does the margin on a drug like that tend to be bigger?
Yeah, and I think Tepezza, even though it hasn't had a significant penetration in the TED market, right now Amgen is marketing this product, and it's at about a $2 billion run rate. So despite the number of patients, there's still a substantial unmet need in the market for this. So if we've got veligrotug launching kind of the middle of next year, and then hopefully Elegrobart maybe a year after that, I think there's still a multi-billion-dollar market opportunity just in the U.S. market here.
So the Edgewise Therapeutics is your next idea. They carried out a trial, and there was some statistical noise, but 2 patients should, in fact, have been excluded. Can you just walk us through what happened there, please?
Yeah, so Edgewise Therapeutics, this is for their cardiac focus in HCM. This is another genetic cardiac condition. Mm-hmm. And the idea with 7500, the Edgewise drug, is hopefully that we can dose something that has a little bit safer profile and is easier to administer. Right now, the standard of care would be Camzyos from Bristol Myers Squibb, a cardiac myosin inhibitor. Well, it's changed a lot in how we treat HCM. It's not without liabilities and some trouble in administration. You have to use echocardiograms to titrate patients up. Hopefully 7500 will present a different profile. We'll be getting some phase 2 data from Edgewise, but you mentioned earlier, the data last year, I think, gave investors pause. At the end of last year, we also got a new safety update from Edgewise. I think a lot of those atrial fibrillation concerns have been alleviated, and the next update in the second quarter will help us understand the efficacy and safety profile a little bit better.
And your final idea here is a company called BioCryst. What are they aiming to fix, or what ailment are they going after?
Sure. So they are focused on something known as hereditary angioedema, or HAE. And this is probably even a smaller market. We're talking about 10,000 patients for HAE. And this is a rare genetic disease that you have random swelling attacks. These can occur in your hands, your feet. The biggest problem is when they occur in your throat, and these become life-threatening. So patients tend to take a therapy that is prophylactically administered, so with regular frequency, to prevent these attacks. And that's what Orladeyo's BioCryst product Orladeo does right now. This is a $600 million plus drug a year today. And I think investors are really concerned, what is the tail for Orladeyo? How long do we stick around? There have been recent entrants into the HAE space in the prophylactic realm, and I think there's concerns there. We disagree. We see a path forward for additional growth. And BioCryst recently acquired another company, Astria Therapeutics. They have a phase 3 program. And this is a long-acting injectable prophylactic treatment that patients would take 2 times or 4 times a year instead of having to take twice-a-month injections, which is the standard right now if you don't take Orladeyo.
Right. And sorry, Orladeyo, though, right now is an oral treatment that you take once daily?
Correct. Yes. So if you don't want to do the injections, I think BioCryst has a really unique offering with the oral product with Orladeyo. They've been showing nice, steady growth here, and they're guiding to over $625 million in revenue this year. The stock is trading at about 2 times 26 revenue, consensus revenue, but the mid-cap peer group trades at about 5 times. So I think beyond Orladeyo, we do have some pipeline updates coming early 27 for the Navenibart program, but then another orphan disease readout is expected towards the end of this year. This is an ultra-orphan skin condition. I think neither of those are really reflected in the stock valuation. So if we can have some commercial execution paired with more pipeline updates, I really like the setup here for BioCryst.
That was Laura Chico, Managing Director in Equity Research at Wedbush Securities. You are watching Trading Day on BNN Bloomberg. Today's business headlines and market movers are coming up next. Stay with us. Bank of Canada Governor Tiff Macklem reiterated that the Canadian economy is undergoing a profound structural shift. Speaking at an event in Toronto, Macklem warned of years of modest growth ahead and said rate cuts might not work in fueling increased activity. He added monetary policy should not try to compensate for lost supply. The Bank of Canada governor also warned Canadian executives need to adjust to the new economic reality. And shares of BCE are seeing some pressure today. The telecom giant posted profit in its latest quarter that beat estimates, but saw operating revenue fall below expectations. BCE says it expects higher revenue and profit driven by improvement in wireless pricing, a boost in product sales, and growth in its AI-powered segment. A reminder, of course, BCE is the parent company of BNN Bloomberg through its Bell Media division. And shares of Lightspeed Commerce are trading lower after it gave a full-year forecast for adjusted profit that came in below what analysts were expecting. Lightspeed's revenue outlook for the current quarter also came in below estimates. On the upside, the payment solutions company posted revenue and profit in its latest quarter that beat consensus, driven by higher demand for its software. And taking another quick look at the TSX, it is down today by 1.4% at the moment. A lot of gold and silver stocks down today because the price of gold and silver, of course, is down, and that is dragging the TSX. If we look at U.S. markets, similar story there in terms of downward trading for the S&P 500, the Dow Jones, the NASDAQ down 1.1% at the moment. We are still getting more earnings this week, with Alphabet reporting yesterday and other tech giants like Amazon reporting today after the bell. Let's get more on this and a broader lens on the market. We're joined now by Teresa Shute, Chief Investment Officer at Harborfront Wealth Management. It's good to have you join us.
Great to be here. Thanks for having me.
So I'm wondering what you think. We're seeing a drop in tech stocks today, particularly affecting the U.S. markets, as we just saw. What do you make of that? And also, like, where Alphabet sits in that after reporting earnings?
Absolutely. So obviously the market appears a bit distraught today. There's clearly a risk-off tone. The market has absorbed some softer employment data, concerns over the increased threat of new AI tools to software companies, and that continues to kind of fuel the sell-off as service stocks like Adobe, Thomson Reuters, Salesforce come under pressure. And I think is all been talked about, but like clearly the advancement of AI, there's a real fear that these traditional moats for these SAP companies have gotten shallower. And Anthropic's Cowork plugin, obviously for legal uses, highlights how AI could really erode application service revenues for IT firms. So we're seeing obviously a lot of weight on those ones. I think they'll continue to slide. And it's interesting because I think investors were expecting or braced for some sort of an AI reckoning, just not this one. And clearly the tone, at least, this week has been a bit of like shoot now and ask questions later. Does it appear like a bit of an overreaction, but really perhaps more indicative of a longer term trend? These AI companies are coming on fast with these advancements that can really reduce costs and put a lot of pricing pressure on these traditional companies. And so, historical patterns may suggest a reversal. But the software sector has underperformed, by approximately 5 standard deviations compared to chip companies. So maybe this is something that was expected to happen, but maybe not right away.
So if I'm reading
yes.
between the lines in terms of what you're saying, then because what we saw this week with the software sector was pretty incredible, that sharp sell-off that you're referencing. Do you think that this could be something we could see more of throughout the year as we start to shift and see AI kind of take over and see these big companies introduce these tools that are maybe very competitive to some software companies?
Yeah, I think it's interesting. I mean, certainly, I would say legal, financial data, and data providers, again, accounting, these are all prime for disruption. So like really any service that's highly rules-based is essentially on the table. But at the end of the day, will this happen today? No, it's going to take time. And ultimately, large companies that, use this, kind of mission critical software, they're not going to, swap for language models imminently. And there's always, more bespoke and elegant solutions that these companies will continue to provide. But it's clear with these, these add-ons that, some of these large AI companies, see this maybe as peripheral business. I mean, they can easily come in there and erode market share pretty quickly. And so I think that's what we're seeing. I don't see, these stocks coming back. At least, to recent highs. But I think, was this a bit of a, an overreaction? Probably. But I think, again, there are structural headwinds to these companies going forward.
So then what do you think investors should do? Because I liked your analogy of like, people are shoot now, ask questions later.
Yeah.
Like, should investors be buying in the dip, do you think?
I think, depending on the company, I think it really warrants a deeper dive and a different look at how these businesses themselves are adopting AI. And I think that's really important because, I think they have to be, just as market efficient and competitive as these new entrants coming into their space. So there's a bit of a, maybe a sleepiness or I don't want to say laziness to what they were doing. Clearly not. They're tech companies. They're very innovative, but I think they're going to have to, start adopting AI much faster and also do a better job of communicating what they're doing to the market.
Okay, looking ahead, because of course we're talking about big tech companies, Amazon reporting after the bell today. Is there anything you're watching for? Anything you're kind of expecting?
Yeah, I think Amazon, we're expecting, some decent results. I think the market is, pretty, I'd say overwhelmingly bullish on Amazon still. Really I think 67 analysts today are covering the stock, say it's a strong buy or just buy. Only 4 of them really have it on hold. So I think, there's a view there that they do have a, sustainable long-term build-out advantage. They've got, very long-standing relationships across the supply chain, and they already have this best-in-class compute infrastructure to complement their business. What we saw with obviously Alphabet, somewhat of a different story. Alphabet beat both, top and bottom line expectations, but the market really didn't like their massive CapEx spend. As the company said, it would double their CapEx from like 2025. So, we're starting to see that obviously weigh on Alphabet, and I think it's pulling the rest of the US stock market with it. On the bright side, the cloud revenue and traffic acquisition costs surpassed expectations. And even with, the higher CapEx guidance, there is recognition that, this infrastructure footprint will create more meaningful moat. And I think what's really interesting is with all this talk about CapEx, analysts and investors may not like that it's, resulting in maybe higher debt or off balance sheet debt and worries about AI monetization. It's certainly creating a lot of opportunities to invest in the picks and shovels part of that infrastructure. So whether that's through chips or data centers, even through the private market, which is participating in a lot of this infrastructure build out, it has created, pretty solid opportunities there. But I think, tech is obviously a big part of the S&P 500, but it'll continue to, move markets and influence how investors are thinking about their portfolios. It continues to be very concentrated, but it is an opportunity now, I think, to rotate out of some of these stocks and start looking at industrials, energy, other sectors, a bit more cyclical, now that we're seeing that the U.S. economy still has some legs.
Okay, very interesting stuff. We'll have to leave it there for today. Teresa Schutt, I appreciate your time. Thanks so much.
My pleasure.
Coming up next, Bazoma St. John, former chief marketing officer of Netflix and former chief brand officer of Uber, sat down with our colleagues at Bloomberg TV. We will bring you that conversation on branding, the media landscape, and the Super Bowl next. Welcome back. Bazoma St. John, former chief marketing officer of Netflix and former chief brand officer of Uber, discussed the tech and media landscape and the Super Bowl with Romaine Bostick and Katie Greenfield on Bloomberg's The Close. And she says evolution is key to everything. Take a listen.
Where big tech is right now, because I feel like we've gone through this, I don't know, it's, most of these companies, we're talking 20, 30 years old, they've had a chance to mature, and there are big questions out what they become next. And I don't understand how companies of this size make that transition and find a way to stay relevant.
Oh, gosh. Well, it's a very big question. Look, and if you can do it well, you keep your job, which means that evolution, is the key to everything. It's like if there are ways in which you're connecting with your customers or your audience and you are a content maker, that is the way you've got to see yourself first, not just as a tech company. So for companies like Netflix or Apple, who produce content for consumption of their audiences, you've got to figure out where are people watching, how are they watching, how are they consuming, and that's the way you evolve.
Are these companies cool, though? Because, like Apple is a juggernaut, but it's also a juggernaut kind of because it's a gilded cage, right? If you're in the Apple ecosystem, you're stuck. I don't have an iPhone because I think it's cool. I have it because it's a necessity. It's a commodity. And you can say that with a lot of these big tech brands these days. And I do wonder if that ends up working against them at some point.
No, I don't think it works against them at all. Look, good is not always just about being small or like the new kid on the block. Sometimes good means that you've been around a long time and people can depend on you. Now, cool, that it depends on trends. It depends on whether or not you're evolving fast enough to stay in the conversation. And so that's really what you're trying to do, is always stay in the conversation of what people are doing, how they are using their technology and their devices. And that's what makes you stay at the top of or in the center of pop culture.
Well, Bazoma, I'd also love to get your thoughts on how a lot of these big tech companies, how they are handling AI and how they should be handling AI, because we were having this conversation with Gary Vaynerchuk a couple of days ago, and he made the point, and I think it would resonate with a lot of people, that there's a skepticism about AI right now. People don't necessarily want to see AI-generated content, but these big tech companies, you could see that perhaps putting them in a bind, since obviously they need to be going all in on AI right now.
Yeah. Well, I would say that, AI is just a new way to talk about how tech makes your life easier or makes it more automated. We've been doing that for a long time. I mean, when I first started at Apple and we're building Apple Music, personalization could be seen as a form of AI, right? In that when you listen to a particular song or a string of songs, now the platform understands what you like and therefore will serve music to you that is in your taste versus like playing the next song, which is completely outside of, the taste that you like, and then you'll be mad. But many tech companies have been using a form of AI for a long time. And so I do think that now we're thinking about AI in ways in which it's, taking over creative jobs, or that it is, creating fake content. But that's actually not true. I think for all of us, what we input into our content preferences is then what it's going to create for us.
I love the point on rebranding, because you even think about something like Spotify. Spotify has been making playlists for me based off my preferences for years now, way before we started bringing AI into the conversation. But when it comes to that point you made, that there's this fear out there, or this feeling that AI is going to take over creative jobs. You don't see it happening right now, but could you see that in the offing?
I could see it happening in terms of making some of our platforms easier for creators to use. I don't think that there's ever going to be a time when the idea of taste, which is what actually powers creative people, becomes automated or takes away from how you actually create your art. And by art, I mean not just, visual artists, but musicians and illustrators. There's just so much that we do which has to do with taste, that it is not necessarily something that can be learned by tech.
I do want to just talk about just the idea of branding. We mentioned your new show with Jimmy Fallon. Yeah. Obviously, you've got your own product lines, including Eve, and just the idea of not just corporate branding, but personal branding. And I don't know if you can maybe just share some of your experience from taping the show and the conversations that you have with some of the contestants, some of the presenters on that show about the best practices in that space.
Yeah. Well, I feel like personal branding has become like this bad word, as if like if you say, oh, I have a personal brand, or I'm developing a personal brand, somehow then you are arrogant and you should not, be focused on that. But if you think about personal brand as simply reputation, that changes the conversation. It changes the perspective you have. Even on my show, On Brand with Jimmy Fallon, a lot of the contestants, week after week, what you're building is your reputation. We expect you to have great explosive ideas, or ones that pull at the heartstrings, or ones that are funny. And that becomes your personal brand. So there was a contestant, BT, who got voted off pretty early, but he's a funny creative. And so even the content that I see of him now on Instagram still is in that same vein. So his personal brand is as a funny creator. But I think for all of us, we can think of ourselves in that sense, that what is your reputation? What is it that you stand for? And that becomes your personal brand.
So then translate that then back, and I'm just going to circle back then to the big corporations and big tech. And the idea is, do they need to think a little smaller, or is it okay for them to have that scale and be, whatever mega brand that they are, and with an identity, to be sure?
Yeah, I mean, look, if you're an elephant, don't consider yourself to be a mouse. There's no way you're going to fit into the small spaces. And so why would you try to maneuver yourself that way? And by the way, you've made an excellent point, which is that brands need to be themselves. Right? It's like anybody. If you think of a brand as a human, and you think about their personality and what they would like to do, the spaces they would be in, you have to remain consistent. That's the way that consumers then trust you. But if you're a big elephant and then you start acting like a mouse, nobody's going to trust you, and they won't believe your brand. And so that's why it's like, if you're a big company, behave like a big company, act like a big company. It's okay. We will still like you.
Be the elephant that you are. Don't be afraid of those regulators. Bozoma, before we let you go, I do want to talk a little bit about the Super Bowl. Of course, we're all waiting for the big game coming on Sunday.
Who's playing the Nets?
Seahawks and Patriots. That is the extent of my knowledge. But let's talk a little bit about the halftime show. Of course, you worked at Pepsi, you worked at Apple. Both, of course, have been involved with the Super Bowl halftime show. And this isn't really a question, but it's interesting how the Super Bowl endures. You know, we talk about sort of the death of linear television, which, you know, particularly hurts for Romaine and I. But then you think about the Super Bowl, and that real estate, when it comes to the halftime show, is still so valuable in 2026.
Yes, yes. Well, because it's the one stage where a performer, a musician can reach so many different demographics of people. You know, usually if you are, we'll take the example, which is Bad Bunny. And while he's an extraordinarily popular artist, his latest album is completely in Spanish, right? Which just won Album of the Year. But the idea that he can reach audiences who may never have heard his music before is extraordinary. And I think for a lot of the audience, they are also tuning in because they want to be entertained. You know, so you have to have people on the stage who understand how to perform, how to gather an audience. And I believe Bad Bunny is going to deliver that on Sunday.
That was Bozoma St. John. And still ahead, today's market movers with Bloomberg's Matthew Griffin. That conversation's coming up right after this break. Stay with us. Welcome back. We're going to take a look at some of the movers south of the border now. And to do that, we're joined by Bloomberg Equities reporter Matthew Griffin. Matthew, it's good to see you. Thanks for joining us. Let's start with Estée Lauder, that company tumbling today. And what's interesting is that the company is saying tariffs are really hitting them hard.
Yes, absolutely. This, Lindsay, the beauty industry has been impacted by tariffs directly. This is a company that has called out tariff impact, I think, of around $100 per year on an annual basis. And they also flagged in their, when they gave a quarterly update to investors, that they are seeing tariff impacts on consumers also in Latin America. So consumers are quick to cut back on beauty products when they are feeling pressure. Tariffs have piled on pain for consumers around the globe. This is all adding up to an outlook for adjusted earnings per share this year that came in below Wall Street's expectations. That's $2.05 to $2.25 US. That is higher than previously, but again, below what analysts were looking for. Now, this stock has surged over the last 12 months. Investors have been betting on a turnaround under CEO Stéphane de La Faverie, but the report and the outlook today undercut some of that optimism. The stock now down around 20%, so just taking some of the air out of that balloon.
Yeah, really interesting to watch that. Okay, so another one that's down today, crypto exchange Gemini at a record low. I believe it's almost down almost 9% at the moment. This after its plan to cut business in a broader crypto slump. What's going on there?
Yes, Gemini Space Station, the crypto exchange, you're right, down around 9% today, and now down about 80% from the record closing levels that they notched after their IPO in September. The immediate news today was that the company will wind down its operations in the UK, the EU, and Australia, areas where they said they just hadn't been able to make as much ground as they wanted, also cutting up to 200 positions, about 25% of their workforce. Now, what looms over this decision, even though it's not something that the Winklevoss twins, Tyler and Cameron Winklevoss, who run the company, addressed directly, is the slumping crypto trading around $65,000, levels not seen since before the 2024 election. Crypto exchanges get a lot of their revenue from crypto trading. Of course, that revenue has been under pressure at Gemini, at peers like Coinbase. That's contributed to a long stock slump that is extending today.
All right, and on the flip side, a company that's up almost 9% at the moment is Hershey after topping estimates in the latest quarter. And what I find interesting here is they're apparently expanding into healthier products.
Yes, Hershey said that they may try to add more protein-rich options to their lineup through acquisitions. It's a trend that you just see at companies all across the country now. You've got the new protein bowls at Chipotle. So I guess now you've even got candy companies hopping in. But the core of Hershey's business is also doing well. They gave an outlook for adjusted EPS this year that was above expectations. And you've got a few tailwinds behind that. If you look back a year ago or even 6 months ago, candy companies, chocolate companies in particular, were facing headwinds from tariffs, also really high cocoa prices. Cocoa prices have moderated, and President Donald Trump has actually exempted cocoa from his reciprocal tariffs. At the same time, Hershey said that consumers haven't cut back as much as they were expecting after they had to hike the prices of some of their products. So they are reaping the benefit from those higher prices, still seeing demand strong, paying less in tariffs. It's all adding up to a really bright outlook this year.
So interesting. Okay, Bloomberg's Matthew Griffin joining us live. Matthew, thanks so much for that. And that wraps up this edition of Trading Day. Thanks for watching.